Hi, everyone. Welcome to today's Adhesion Manager Spotlight. On the call today, we have Brett Golden, who's the president of Trowbridge Capital Partners, and he's going to be going over through the investment overview for his firm, and touching on a few pieces here. So, I want to thank very much, Brett. Thanks for joining us.
Hi, Patrick. Thank you for having us. And we're excited to demonstrate our strategies in a very competitive landscape that I think we provide some very unique strategies that provide alpha for advisors. So let's just go right into the presentation here. All right, so I'm not going to go through every single slide just for because of time restrictions here. So we will just talk about why Trowbridge, who we are, our philosophy, portfolio design and construction, the portfolio selection process, and risk management. And then we could talk about two solutions that we have, the dynamic alpha and dynamic low volatility. All right, so the first thing I just wanted to highlight before we even get into who we are, the dynamic alpha product, we are in the 1 percentile of alpha generation for large cap core managers for the SMA Morningstar ranking. And we are 5 stars for this product. We just received this about a month ago, so wanted to highlight that. All right, so a little about Trowbridge. We have a little over a 4-year track record with our strategies. The 3 partners personally have over $20 million of our own capital in the strategies. And we are a SEC registered investment advisor based out of New York City. Our chief investment officer is based out of Chicago. And we're using quantitative models that my partner developed about 20 years ago. So we do have about 20 years of research behind our process and strategies. He was the head of futures research at Prudential and left with a gentleman by the name of Jack Schwager, and they started a global macro fund many years ago using the same underlying models. And back in 2011, we started to provide these quantitative models to the buy side for equities predominantly. And the key focus of what we do is risk management. So we believe that our edge in providing alpha and long-term compounding returns comes from our ability to effectively manage risk over a longer market cycle. All right, so our philosophy is pretty straightforward. Again, risk management is paramount to generating alpha. We try to mitigate based on the specific strategy we have. Each portfolio, and we have 4 portfolios, each are designed for a different risk budget. How do we mitigate drawdowns, downside volatility without losing too much upside return? The second philosophy is in terms of factors, because we look at 2 factors in what we do, and that's risk and trend. But we do not believe that the growing movement of factor-based investing, that investors can extract meaningful excess returns out of typical factor premiums, because everybody is now looking at the same exact factors, whether that be calculating momentum the same way on a 12 and a 6-month look back, value, typical fundamentals, quality. So everybody today is now crowding these trades. They're becoming extremely crowded, which is also causing a lot of momentum crashes as well, which we will go into. The third point here, we don't believe that indices that are cap weighted are efficient and also present a lot of risk. So everything we do is equally weighted, as we're not trying to forecast fundamental returns in the future. And that leads us into the 4th bullet point. We don't believe forecasting the fundamental returns of a stock are necessary to outperform the benchmark. And as we mentioned before, mitigating downside volatility is required to generate significant compounded return over a market cycle. All right, so when we started, the strategies, we said, okay, why are we starting Trowbridge? Why are we developing these strategies? We wanted to create a better long-only solution that focuses on risk. And as people head into retirement, and additionally heading into one of the longest expansions or bull markets in history, how can people get an equity risk premium like return, but yet also mitigate some of that downside volatility where they can sleep at night? And we do this via our mission. And the mission is reducing portfolio correlation to the S&P, which the dynamic alpha product, that's its benchmark. So we reduce portfolio correlation by avoiding crowded trades, both on the security level and also looking at the broad market level in the portfolios, which we will get into. And additionally, we are implementing a proprietary process for exiting and entering positions. So these three key points will also create higher tracking error, and we are not scared of the higher tracking error, because what we are trying to do is generate alpha and not be a closet indexer. All right, so essentially everybody, for the last 9 years has talked about how do we de-risk a portfolio in stressed periods or stressed markets. And what we try to attempt is to constantly readjust the portfolio's beta based on the portfolio's risk budget, which we will show once we get into the portfolio. As the S&P increases in strength and there's less market strength, we will increase the portfolio beta as well. One key point that we'd like to highlight is we have found over and over that using individual stocks instead of ETFs is superior in terms of managing risk, because the signals are generated with individual stocks much more quickly, and we can discover price efficiency of individual underlying stocks. The issue with ETFs, they're slow to move because they're a composite, so often the ETFs were already had made a major move, and it's rather too late to de-risk a portfolio or readjust the portfolio beta. So we feel that using individual equities is superior in our process, even though we are investing in a concentrated portfolio of 30 to 35 stocks, equally weighted. All right, and that leads us up into the portfolio construction. So we're using two factors. The factors, again, we're looking at risk. We're looking at beta for risk and volatility. Both are slightly different in terms of portfolio risk. And then we're using trend and mean reversion with our proprietary quant engine that I will get into and show you how we are different. And that's really the bread and butter of what we do. So again, we're equally weighted for each position, 2.88% to 3.3%. The average holding period could last, depending on market volatility, anywhere from 2 to 9 months. There are some unusual periods that we will go much longer, over 12 months, like a 2017, where the market was just trending extremely hard, where there was very little selling. All right, I'm not going to go through the entire process. I think the most important aspect of what we do is the risk management and removing positions. So I just wanted to highlight the mean reversion on individual security level and the overlay of the S&P. So we'll dive into the next slide that will give you a better representation of how we manage risk both on the individual level and the security level. All right, so this is looking at the S&P 500 quantitative model. It's a blended composite of our trend and mean reversion model. And what we can see here is going back to 1992. When the model gets to 90, we also often see 88% of the time, almost a 6% correction. So what we do in terms of all our portfolios, we will stop buying securities when the model gets up to an 80 reading. Now, typically when we have very exhausted or overbought securities then that start to show some weakness or mean reversion, we may raise some cash, which will let us buffer any potential pullback within the market. And I'll show you how that has worked in the past with our portfolios. Now, additionally, for the low volatility portfolios that we run, we will stop buying new securities when the model breaks below a 0 to cushion the impact of any potential further downturn. Most likely we'll be sitting in cash, and I'll show you in the fourth quarter of 2018 how that helped significantly in all of our portfolios. The most aggressive strategy that we have is our dynamic alpha, which is allowed to keep buying until a -50 if it finds opportunity within the market. All right, so this is the first line of defense in managing portfolio risk. Okay, so in terms of the buying process, we're using a rating value and a mean reversion model. And each portfolio, regardless of its risk, has the same exact buy signal across the portfolio. This is purely price and using many different volatility metrics as well, because we're looking for securities that are not experiencing high levels of volatility. Once we hit a buy signal, we then look for further confirmation with our counter trend. The counter trend is our risk management tool. The further negative it goes, the greater confirmation that buyers are stepping into the market, sellers are backing away. We never buy a stock ever because it's overbought. We want to remain in the market as long as possible because where we make our money is that fat tail parabolic move at the very end of the price appreciation. So typically, this could last an ideal trade for at least 12 months. Now, what happens is, in terms of our risk management, we will not, in terms of trying to avoid crowded trades and avoid mean reversion or those big momentum crashes, we're not allowed to buy a stock that has already seen some move in terms of exhaustion. So a -39 on the counter trend, we're not allowed to buy any stocks. So additionally, we consider anything approaching overbought a -49, overbought a -69, and extremely exhausted a -95. And what happens is, as the price continually, or the counter trend continually declines, because there's nothing to look at on the top line, the rating value, the models will only look at the counter trend. Once the counter trend starts to weaken and increase, so let's say it goes from a -84, 83, 82, 81, we will then sell the individual stock. The more negative it is, or the more exhausted it is, the less time we give it to fail, because we have a greater return and the potential for greater mean reversion could potentially happen. So, as we mentioned earlier, we are not using traditional factors, and we're not using traditional momentum to buy stocks, because what happens is, as we've seen with a lot of momentum products, they often lag significantly in V-shaped recoveries. They're often too slow in the initial correction, and there's a lot of herding where everybody moves into the most popular stocks. And if I haven't mentioned, we're only investing in S&P 500 companies. So nothing outside the S&P, and we do that for a number of reasons. Liquidity, there's the most sell-side research where stocks are the most efficiently traded. We do, however, and this is how most practitioners and using relative strength, and this is how the iShares Momentum MTUM ETF looks at momentum, and that's looking at a 6 and a 12-month blended look back with some volatility. And the only thing that we do in our models in terms of looking at momentum is not for the buying, it's actually for the selling of the securities in the portfolio. Now, going into what I think is probably the most important part of what we do, and it's purely proprietary, and how we look at price completely different than the rest of the market, and we like to say we diversify away from common practitioners, is our underlying quant models. So we have the rating value in blue and the mean reversion counter trend in black. The blue line, which you will see represented on the previous slides, is a green bar, and the counter trend was the red bar. The blue line is when we're entering a position, and the black line is allowing us for confirmation to stay in the stock, and also helps us to exit it in terms of risk management. So why is this different? We believe that these models are extremely robust, where they remove a tremendous amount of price volatility out of the price series. So in this example, we have Disney, and this is the chart or the equity curve of Disney, I think in 2016 in November. We will enter the position again across all portfolios, and the essential buy process is anything that has a consecutive increase in the rating value above a 70, we will enter the position. And by the way, any advisor that signs up will get access to our models where they can follow along on our proprietary technology platform, and it essentially looks like this. So there's full transparency in what we do, where the advisor can follow along and get better insight into why the models are buying and selling. All right, so as you can see here, we probably went to a buy mid-November, somewhere around a 70 reading on the rating value. And it was, for 7-8 months, extremely robust, very flat, no noise, nothing to really look at in terms of the rating value. So there's a lot of confidence to remain long. Even more importantly, the counter trend moves further negative, where it's giving us further confirmation that buyers are stepping into Disney, sellers are backing away. And this looks great. It's not overbought. Now down here, we are seeing some overbought, but we're not seeing any reversion or weakness in the counter trend. Now, when I say we look at price differently than the market, many practitioners will follow an overbought indicator like RSI that doesn't allow you to capture the long-term move of a trend, where you are getting that fat tail parabolic move and a potential 30–40% gain over the course of a year. And as we can see here, for many of you that are familiar with RSI, we've had a lot of false signals, moving from 70 back down to 60, back up to 80. So for anybody that's not doing short-term trading, this is extremely noisy and difficult to get any visibility into whether or not Disney has exhausted its longer-term trend. Additionally, in terms of momentum, very similarly, you have MACD here, which is an older oscillator. It's not a model, but the theory is to grade the momentum of the security. And again, we have many failed signals where you had the fast and signal line cross over about a half a dozen times, and then on top of it, both lines are decreasing in momentum. If you were to look at this, you would have thought that the momentum was completely failing, and the shelf life of this was not very long and did not give very good visibility into a stock that continually moved up, and you wanted to hold this for as long as possible for little or less turnover. So that is our bread and butter, and why I think we provide an edge in what we do, looking and diversifying away from common practitioners of pure price. All right, so let's go into the dynamic alpha strategy and see historically how this is done in terms of risk-adjusted returns. All right, I've outlined a lot of peers in a number of different areas, and what we're looking at here is the capture ratio. And the capture ratio is essentially, or I'm sorry, this is the alpha, I'm sorry. So alpha here, since this is, I think, a 3-year look back, not inception, and I'm comparing it against a Darcy Wright blended FV ETF, which uses relative strength, AQR's momentum index. We got Darcy Deutsche Bank's quantitative product, Dimensional, that uses some factor-based quantitative analysis. S&P, the Vanguard 60/40, American Funds, Pollen, a very good firm growth product, and then Fidelity Advisor Growth. So I'm giving a kind of a wide range of different peers within the large cap space, looking at purely alpha. Okay, and then what we have here, which really lines up again with alpha, is the capture ratio. The capture ratio here is really blending both the upside and the downside capture, so we don't have to look at two charts. And again, it's showing that our DA product has done a very good job in participating on the upside capture of the S&P's returns and also mitigating the downside of the S&P drawdowns. And then lastly, which again lines up with the capture ratio in alpha, is the Sortino ratio, looking at essentially downside volatility. I like it a little bit better than the Sharpe ratio. And again, I think we've done a pretty good job in terms of mitigating downside, those bigger downside risks. All right, so I'm pointing out a couple different factor, trend, momentum products. And why I'm doing this is I wanted to show some issues of those large momentum crashes that are really just intolerable with pure momentum strategies. So in 2016, we started to lighten up the portfolio because we had a lot of overbought, extended securities in the portfolio in the dynamic alpha. And we started to lighten up. We couldn't buy anything because of where the S&P was. It was extended. So we were in a higher level of cash. We were probably in about 40% cash at that point, and then reallocated again 2 to 3 months later, and we were able to take advantage. We had, I think the S&P at the time had about a 9.5% drawdown. This product had about a 6.5% drawdown. And as you can see, some of the other peers in the group had a pretty tough time in terms of a momentum crash. Now, again, these are concentrated portfolios, so initially you will see in a regime change some volatility, but we are in a higher level of cash at this point in October of 2016. But what happened was we were able to shift quickly into financials, and a lot of our momentum peers could not, because when you're looking at pure momentum for your buy signal, you can't buy a stock or an ETF or a sector that has a negative relative or absolute return on a 12-month or a 6-month look-back period. And at this time, financials, I believe, had a negative 12-month look-back return, and that really helped us to jump into financials and take advantage of a big rally back in that sector at that period. All right, so the next large drawdown we could see here was coming into 2018 February. We were in about 70% cash. I think we lost connection here. Can you guys hear me?
Hey, Brad. We can hear you now.
Okay, great. I don't have a connection issue. Okay, hopefully that. Okay, so what happened was 2018 was the most extended period, overbought period, going back to actually about 1988. This chart's only going back to 1990, and it was actually more exhausted than 1995, which was actually a pretty good period for the S&P. So what happened was, once we got up to an 80, we weren't allowed to buy any securities. So if the portfolio was selling any securities because of that mean reversion model that we discussed, we had to stay in cash. So at that point, we had about 70% cash, which helped us weather that I think it was about a 10.5% intra-month pullback, peak to trough in the S&P. This product, which is our most aggressive product, only fell about 1.8%. And then we started to reallocate again. The model did get tripped up a little bit, but I think we did a very good job in holding on to the portfolio gains. Now, leading into the fourth quarter of 2018, June of 2018, the portfolio had 25% allocated to technology. The portfolio beta was about 0.91. What happened was technology started to weaken off of a very extended level. So the models by September started to reduce equity exposure, and we went down to almost a 0% allocation sector weight to technology by September. We started to reallocate to utilities and REITs. The portfolio by September had a portfolio beta of 0.41. Now, we outperformed the S&P by about 2% for the fourth quarter. We only ended up down 1.2%, I believe, with fees for 2018. Unfortunately, everything was hit into the fourth quarter. Utilities and REITs and staples were the last to go. But we were about 90% allocated, only had 10% cash because the models did not go to a depressed level where we were raising any more cash, because this is our most aggressive portfolio, which I will show you how our dynamic low volatility portfolio conversely was sitting in 80% cash during the fourth quarter. Okay. All right, so let's talk about the dynamic low volatility portfolio. I don't know how much more time we have, but essentially, this is a low volatility portfolio, low cost alternative to what I believe to a equity hedged index, the HFR XEX strategy. It has a lower drawdown since inception, only 7% versus the index of 11, about 50 basis points lower volatility. And what we're trying to do with this portfolio is, let me see if I can see the statistics. The portfolio beta since inception is about 4.1 versus the index of 3.6. The R square is very similar. Again, the drawdown is 300 basis points less than the hedged index. And we have about 30 to 20 basis points annualized less volatility. The correlation, though, since we're only using cash as a hedge and not shorting stocks, the correlation is about 0.41. So anybody that's looking for alternatives at a lower cost that are an alternative to a long-short hedge index, this could be a good product. Or someone that's looking for a low volatility product that can raise cash, it's a very good product instead of maybe a S&P low volatility ETF. This product in 2018 was up 3% and did a very good job in weathering the storm. And then again, this product year to date is up 7.36%. In May, this is as of yesterday, down 0.1%. Now the portfolio as of May 30th is up about 40 basis points. So this is a great solution for those that are heading into retirement that can't afford to take a long duration risk of large portfolio downturns, drawdowns, or potentially looking to replace some equity risk in retirement. Instead of maybe a 60-40 allocation, maybe use this 40% allocation in the equity universe. So how do we fit into a portfolio? I think both could be a nice barbell approach, whether you're looking to allocate to U.S. equities, it could be a value, it could be a blend, it could even be a growth, where you could replace all three of those, where we're constantly readjusting the portfolio beta on the overall health of what's happening with the S&P 500. So advisors don't have to go out and pick and select a value fund, a low vol fund, a blended fund, or an aggressive growth fund. And then, by the way, we are GIPS compliant in all the strategies that we provide. So I'll take any questions that you have, Patrick. I know we're up with time here.
No, that was great. Thanks so much, Brett. I really, really appreciate it. We had a couple questions here. So let's see. Thank you for going more in depth on the DA strategy. It seems like a unique approach to quantitative investing that works well in a UMA environment based on the number of positions within there. So I wanted to point that out to any advisors that are listening, just based on the 30, 35 stocks. Wanted to see one question that came up. How often in that strategy do you guys make trades? Like, what are I know you're looking at it on a daily basis, but would you say how often do you actually go ahead and buy or sell, depending on your signals that you receive?
It's a really good question, and it has to deal with the underlying volatility of both the S&P and the market. So just to give you an example, the S&P, well, now the S&P is up about 10%, but it was up about 17, 18%. Off of that strong rally, there's been very, very little portfolio turnover in the S&P 500, or in the portfolios. I'll give you an example of what we own right now. And there hasn't been any reason to sell anything because of the strength of the underlying stocks. So out of 35 stocks, we've probably only had 10% portfolio turnover, which only means we probably only bought or sold 3 to 4 stocks in each portfolio, and we're almost 6 months into the year. Is that typical? I won't say it's typical. But it really depends on the strength of the portfolio. And again, it's too hard to forecast, but just to give you an idea, these are a lot of the names that we own. These are all large cap, well-known names. And so I'm sorry I can't give you a direct answer. These portfolios definitely will be better off in a tax-efficient account like an IRA or a SEP or some type of qualified plan. There's a very fine line between risk management, mitigating downside volatility, and being tax efficient. Our objective is we're trying to do both. We could probably even do a better job of risk management, but that means we're going to be even less tax efficient.
Perfect. Makes sense. Thanks so much. And second question we have here is on the low volatility product, which, by the way, there's not as many low volatility products on the Adhesion platform, so this would be a really strong option for someone that's maybe looking for that. Wanted to take a look at when it comes to the weightings of the individual tickers, and I understand we're using stock holdings within this. Is it equal weighting, or do you guys assign a different weighting to some of the different stocks within it?
No, we don't. And I didn't even go into the specifics, but let me just give you a little bit about how we designed that portfolio, because I think it's really unique. The portfolio in a normal market environment, and again, when I talk about normal market environment, I'll show you real quickly. Okay, so a normal market environment with that dynamic low volatility portfolio would be somewhere between 80 and a negative 10. That portfolio can only seek stocks that have a portfolio beta of 0.60, and then it can only have a certain type of volatility metric going back on a 1-year volatility basis. We don't look at anything past 1 year because then it suppresses the volatility too much. But what happens is once the portfolio, the S&P moves above an 80 and we feel that we have to add a little extra risk, if the portfolio itself only has a beta of 0.41, we will then look to increase the portfolio beta and the stocks will then, we're allowed to buy stocks that have a beta of 1.25. So we increase the risk a little bit. But to answer your question, I just wanted to give you a little more detail into how we look at risk on that portfolio. Everything is equally weighted with that portfolio. And additionally, we give stocks a little bit longer not to work in that portfolio because historically these are higher dividend paying stocks with lower beta. So if we can capture maybe some of the yield while we wait a little bit um, in a weakened state, we will. If it gets to an extremely weakened state, we're just not going to wait that much longer in terms of holding onto that stock. So
Fantastic. Makes so much sense. So thank you very much for that. And wanted to say any advisors that are listening, they're looking for more information. There's going to be collateral and fact sheets on these strategies out there on the Adhesion platform. Please feel free to utilize the Manager Communities feature. You can also find more information via your relationship manager, so please feel free to reach out to them as needed. Brett, thank you so much for your time today.
thank you. I appreciate it, Patrick.